Now, our next guest says if that lockdown drags out any further, it's going to force Asia to lower Q4 numbers. Peter Churchouse is the Managing Director and Head of Research with Morgan Stanley. He's joining us now live in our Hong Kong studios for a discussion. Peter, it's good to have you with us on this program. Let's just get your thoughts first on the impact that a prolonged lockout on the West Coast ports is going to have on Asian economies. You see Morgan Stanley revising Q4 growth estimates for the region?
I think at this stage probably not, but if this goes on for another couple of weeks, I'm pretty sure we will be revising our GDP numbers down. This could be quite devastating to an economy which is essentially export-driven. If we get a major lockout or blockage here for a long period, this is going to definitely have a big impact. It's going to have a big impact on corporate earnings as well as the macroeconomic GDP numbers.
Peter, there's been a lot of talk, obviously, about how big the impact is going to be, and it seems that much of the media has focused on this $1 billion a day number, which came out of a report last week. What's your particular estimate? Have you done any number crunching on this?
Well, the $1 billion is about right. The West Coast ports in the U.S. Take in something in the order of 300 to 320 billion US dollars worth of goods last year. So that figure's probably up a bit for this year. So the $1 billion a day number is about right. We think this could be 0.2, 0.3% off the regional GDP if this strike goes on for about a month or so. So it's a significant impact on the regional economies. This potentially as markets such as Singapore, Hong Kong, China and Korea are perhaps the worst affected. Southeast Asian markets like Indonesia and Thailand, Philippines, less affected.
Peter, if we can, let's, you know, the ports are not the only story affecting all of us here in Asia. It's also that employment report that came out of the U.S. on Friday. A lot of people throughout the whole week were saying, let's wait for the unemployment numbers. They're coming out on Friday before we sort of figure out what the Fed is actually going to do. But those numbers themselves were quite muddy. They didn't really give us any very clear data as to what the state of the U.S. economy really is at the moment.
Yes, you're right. The employment numbers were a bit mixed. On the one hand, the payroll number was down more than people expected. But on the other hand, another survey showed that the unemployment rate was actually a bit better than expected. I think the numbers aren't that bad, actually. We've seen, for example, although unemployment may be still quite high, we're seeing actually the numbers of hours that people work is actually up last month. That's a good sign. Also, we're seeing the payroll in actual dollar terms of people who are in work are getting paid more. That was up about 1.4%. So I think there's a bit of a series of mixed signals here. I don't think it's as negative and as bearish as perhaps we should be, that the market is actually interpreting.
Well, Peter, the market only turned bearish after having looked at the numbers for a while, and part of the problem was the housing survey that they do came up with this number that in the past 2 months there was something like 1.1 million new jobs created in the United States, which on the back of all the evidence we've seen from the corporate side, from the non-farms payroll data, from the real hard numbers, it seems an absurdly high figure. No one can explain where on earth that came from.
Well, that's exactly right, and I think the problem is that there are two different kinds of surveys. The payroll survey is actually done by surveying companies. The unemployment numbers are done by surveying households, and these do actually come up with quite different results, which do appear to be contradictory, and nobody really knows how to explain those at this stage. But yes, they do appear contradictory. But I think at the end of the day, really, the numbers such as incomes going up, hours worked going up. We're seeing a modest uptick in business investment in business equipment. That has been advancing quite steadily. So I think to me that suggests that some sort of economic recovery in the U.S. is reasonably well established.
All right, Peter, you've been reasonably bullish on the few times you've been on the show of late. We'll pick up the story on what it might mean for the stock markets in a couple of minutes if you'll stay with us for a short while. Peter will be in our Hong Kong studio for a while longer. We'll come back to him in a moment. In the meantime, let's go back to Hong Kong. Peter Churchouse of Morgan Stanley is standing by in our Hong Kong studio still for more conversation on some of the economic and market action going on right now. Peter, last time we spoke on this program, we were talking about stock market indexes, and you were quite bullish about equity prices and talking about a bottom. We're now seeing the Hang Seng index falling below its 9/11 lows, and certainly the US indexes are showing some weakness too. Are you still bullish on markets, or is there further weakness?
I put it this way, I think it's very hard to expect Asian markets to completely decouple from the US. I think that's unrealistic, but having said that, the Asian markets have performed much, much better than most other markets around the world. In US dollar terms, the Asian markets are only down about 7%, 8% this year versus 25, 26% for the S&P 500. So in relative terms, Asia is doing a lot better. I know my hedge fund clients tell me you can't eat relative performance, but having said that, if you do have to be invested in equities, Asia is performing a lot better today than the key markets in the US and Europe.
Peter, it's Bettina once again. Can we stick with Hong Kong for just a second? We've seen some very interesting moves on the tracker fund all of last week, a rather big sell-off that a lot of analysts indicate might point to us seeing a bottom for the Hang Seng. What do you think?
Well, I think we're pretty close to a bottom in the Hang Seng, but having said that, though, we're still not at what I would call blood-on-the-street valuation levels yet. We're not at the sort of levels that we saw in '98 at the time of the Russian crisis. Our dividend discount models tell us that the market's about 15% undervalued. When you get to 20 to 25% undervaluation, according to these models, we find you have a very high probability that you'll make money on a 12-month view. So at around the 8,000 to 8,400 level in the Hang Seng, I'd be looking to aggressively buy this market.
So what you're saying, in fact, Peter, is that you're expecting to see blood on the streets, which has not yet arrived.
It certainly hasn't, and I think we've certainly got some downside risk short-term. But having said that, once we get to that sort of level, you're finding stocks that in this market that are growing quite well, giving you 10 to 12% growth, trading at single-digit multiples below book value. When you see stocks, good quality stocks at that sort of level, I think the chances are you'll do quite well on a 12-month basis.
Peter, you're overweight Taiwan, Korea, Singapore, which none of which are doing well today, but that notwithstanding, what do you like about these economies right now?
Well, we're actually not so much overweight Taiwan. We're slightly underweight that market, but overweight Korea. I think the story in Korea is that it's not just an export story, but a domestic consumption story as well. The consumer has been quite strong in Korea. That's what we're looking to see in Asian markets, that we just don't rely on exports, but we're also looking to see good domestic consumption. Singapore is really just a valuation story. It's a very, very cheap market right now, and if we do see a sustained pickup in the US, we should definitely see a pickup in the Singapore market. We're actually underweight the Hong Kong market at this point, still expecting, I think, some weakness in the short term in this market.
And just to finish off, Peter, you just said on a 12-month view there may be some bargains out there. What about a 24-month view? What about a 5-year view? Are you of the opinion that we should be talking trading rally profits here, or are you a buy and hold man?
Put it this way, I think on a 3 to 4 year view, we're in the bottom of an economic cycle right now globally. On a 3 to 4 year, 5-year view, I have no doubt whatsoever that we'll come out of this global recession, and equities will provide some very, very attractive returns. Perhaps not as attractive in the late 1990s, but something in the order of 10 to 15% in this part of the world per annum is not an unreasonable expectation. Earnings growth in this part of the world is 20% this year, about 22% next year. That's not too bad at all.
Right, Peter, thank you very much for being with us this morning. We've been speaking to Peter Churchouse with Morgan Stanley.
And I would love to have picked up on that comment there he made about a global recession, because not many people will use that phrase these days. But next time Peter joins us, I'll ask him about that.